It was another roller coaster ride for stocks today, but we did see some leadership from energy. But at the same time, renewable energy weakened and tested its 20-day moving average. Welcome, everyone. This is the final bar. Welcome back, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'll be guest hosting this week for David Keller. Dave has decided to make a trip from the West Coast to the East Coast. He is at the CMT Symposium in New York City. He is joining a lot of his CMT colleagues at that event, and we'll be back on Friday. We'll talk about that a little bit later in the show, but he will be hosting a live show from the CMT Symposium later this week. But between now and Thursday, you got me. I love coming on here. I've been a guest of Dave's here on the Final Bar, and I think I've hosted in the past, and it's really a pleasure to join you. I'm going to go through and give you the market recap the way I see it. May not be exactly the way Dave does it, but maybe give you a little bit different perspective today. So let's take a look at what happened today. It is Monday, April 24th. You can see that the Dow Jones Industrial Average finished up 67 points. The S&P 500 up about just under 4 points. The NASDAQ was the laggard on the session, losing 35 points. Drop down to the small caps and mid caps. You'll see basically flat on the day. And the volatility index, which had been on the rise early in the day as the stock market was losing ground, actually reversed and finished down 0.02 today to 16.75. It continues to trend lower. And for me, it's an indication that the market is no longer expecting that that volatility that we normally see associated with market weakness. So in my opinion, this is a bullish development, and we'll see whether or not it continues. But for now, that trend in the VIX is down. I wanted to take a little bit different look at the way I would be going through and maybe recapping the action. So I set up a few chart lists, and you can do this really easily on StockCharts. I set up a chart list with 6 of the major indices. So I've got the Dow Jones, S&P, NASDAQ 100, S&P 400 mid cap, and then the small cap index, the 600 small cap. And the reason I like to set them up in a chart list is, number one, I can then sort them very quickly to see what was the best performer and what was the worst performer. And quickly, that's the Dow Jones leading. NASDAQ and the NASDAQ 100 were lagging today. The other thing that you can do is if you have these in a chart list like this, you can pick different time frames. So for instance, if you wanted to see which index, how they have performed year to date, if you have them in a chart list, just go to this drop-down menu and click on year to date, and it'll show you there. Now we've got a different look. So in 2023, we've been led by the NASDAQ 100 to the upside, with the NASDAQ not far behind. Then it was the S&P 500. And then you've got the small caps and the mid caps. You can see the small caps are basically flat on the year, even though the NASDAQ 100 has risen almost 19%. So pretty interesting way of looking at it this way. Then I also have another chart list, which shows the major sectors. So you can see XLK. I've got them in numbered order. And the reason I number them is I put all of the aggressive sectors together. The XLK, the XLY, the XLC, the XLI, XLF. And I can quickly just kind of glance over and see that 4 of the 5 aggressive sectors were down. So we did have a nice rally. But as I mentioned, the NASDAQ finished in negative territory. And a big reason for that is these top 3, XLK, XLY, XLC, all finishing in negative territory as well. If you go to the bottom of the chart, or even toward the middle of the chart here, you'll see the next 4 sectors from 006 to 009. I've got all the defensive groups. So I've got consumer staples, healthcare, real estate, and utilities. And when I look at those four groups, 3 of the 4 were higher today. So I can quickly get a feel for the fact that it was more defensive oriented. That's where we saw more of the strength today, and less strength in areas like the aggressive groups, the technology, consumer discretionary, and communication services. Down at the bottom, though, there's where you see your leadership. The XLE, as I mentioned at the open, energy having a really strong day. And then I can just quickly pull up the chart and we can take a look at what happened. So here on the XLE chart, we had a gap up the beginning of April. We pulled back, put in support right at about $84. Notice we went back up, made a slight breakout, and it looked like maybe a breakout of a bottoming head and shoulder pattern. So I see a left shoulder, neckline, head, right side of the neckline, little bit of a pullback, and then what appeared to be a breakout. Now, sometimes, I've been doing this for a long time, I do see these head and shoulders break back. After they occasionally will do these false breakouts, and then they pull back, and sometimes we'll hit that 20-day moving average and then take off again. So I liked what I saw today on energy. I like the fact that we were moving back off of this key area of support around $84, also off the 20-day moving average. And I think if we can continue that strength back to the upside on the XLE and get back through $86.5, $87, I think this sets the XLE up for a further run to the upside. Moving on, I wanted to do one other chart list with you, and maybe we'll take a look at some of these individual stocks as a result. But here you can see I've got, this is a little bit more. I've probably got about 110 stocks in here. And what I've done is all of the 10 top holdings of the XLK are in this list. So the XLK, I've got all the technology 001, and then XLK, then the stock, and I've got it in order. At the very end of the name, I've got the percentage. So for instance, Apple right now is 22.95% of the technology group. And I've got, excuse me, all 10 of the top 10 holdings right here at the top on technology. Then the next 10, I go into the XLY. So I've got Amazon, which is the top holding. And then you go right down the list. The next, these 10 stocks on the XLY. And the reason I do this is after I go through the sectors and I see what's leading, I can then go to the top 10 holdings within each sector and find out where that underlying strength and weakness is for each of the sectors. So here on the technology, I mentioned when you look at the overall group and you see technology right here, if we do it in percentage order, you'll see technology was down here right near the bottom. Only real estate had a worse day today. But where did that weakness in technology come from? Well, we should be able to figure it out from the top 10 holdings. We've got Salesforce.com, CRM, which is about 2.68% of the XLK, losing 1.8%. Then we have AMD dropping a little over 1%. Microsoft down 1.4%. We'll be getting Microsoft's earnings out later this week. Personally, I think they're going to be very strong. But Microsoft is almost 23% of the XLK. When that stock goes down 1.4%, it's going to be felt in the XLK. So this is just a little bit more of a drop down, if you will, to where we can actually dig into the XLK and find out exactly why it was so weak. So let's take this another step further, and let's take a look at the XLE, which is down at the bottom. So here are the 10 holdings of the XLE. And I've got the percentages out to the side. And you'll see that XOM, which is ExxonMobil, and CVX, which is Chevron, they're about 43% of the XLE. And ExxonMobil was up 2%. Chevron was up 1.6%. But it wasn't just those two. Look at the entire top 10 holdings. Everything in energy was moving higher. So if you really want to dig in and just take a different look at the market recap or the market action for the day, I think this is a really good way to find out a little bit more about what truly transpired throughout the session. So what we'll do here, let's take a look at ExxonMobil. take a look at a couple of these stocks. ExxonMobil, I'm going to use the inspector button here. The high close on this stock prior to today was 118.26. Today's close, 118.20. Intraday, we had a breakout, failed to hold, came back down, and you can see volume ticked up a little bit, wasn't huge, but we are right at a major level on ExxonMobil. If we go back again, pull up CVX, that's right here. We can take a look now. I don't need to look at a relative chart to see whether or not ExxonMobil is performing better than Chevron. ExxonMobil is up challenging its high for the year. Chevron still has a ways to go. So of the two, clearly to me, ExxonMobil is the better performer. So this is one that I think we're going to have to, this is something that we'll keep an eye on. But for now, if ExxonMobil makes that breakout, I actually like ExxonMobil better because of just the nature of its chart relative to CVX. Now let's go back out and take a look at that XLK. I mentioned Microsoft will be reporting. So let's take a look at Microsoft. And Microsoft went up, tested its 52-week high just recently. You can get rid of that, Mr. Inspector. But it's pulled back to the most recent breakout level. So I would be looking for Microsoft somewhere around 280 down to maybe 275 to find some really good support prior to its upcoming earnings, which will be out fairly shortly, just in the next couple of days. All right, that was a little different way of taking a look at the market wrap, but we're going to take just a quick commercial break. And when we get back, we're going to jump into the Final Bar mailbag. We'll be right back. Welcome back, everybody, to the Final Bar. If you are looking for David Keller, he's not here. He is at the CMT Symposium on the East Coast in New York City. He will be back on Friday to join with a live show. We'll talk about that in just a second. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. I host a number of shows here at StockCharts in the mornings. I also write a number of blogs. Many of you probably have seen some of my work. It is a pleasure, an absolute pleasure to be with you all today and sub for Dave. I can't possibly fill those large shoes, but I'm going to do my best here over the next few days. I do want to go into a couple of announcements before we get into the mailbag, so let's take a look at those. All right, first, I'd like to encourage you to send in your questions so that they can be answered live on air. Our email is thefinalbar@stockcharts.com. You can tweet us at FinalBarSCTV, or you can put a comment below if you're watching us here on the YouTube channel. Be sure to like the video as well. Also, I'd like to share the upcoming guests that I'll be interviewing the rest of this week in the upcoming schedule. So tomorrow, Tuesday, April 25th, I have the pleasure of interviewing one of my good friends, Bruce Frazier. He'll be with us on Tuesday talking all things Wyckoff. On Wednesday, another great friend of mine, Arthur Hill, will be joining. He uses a lot of quant methods. I think you're going to find his presentation fascinating. I always enjoy talking to Arthur. And then on Thursday, it'll be a special reunion, kind of, because I used to do Market Watchers Live with Aaron Swinland of Decision Point, and Aaron is going to join me on Thursday, so I'm really looking forward to that. And then on Friday, April 28th, as I mentioned a couple times already, Dave will be back with you. He will host the show live from the CMT Symposium in New York City. The live broadcast will be from 1 to 2 p.m. Eastern, so that's a little different start time, 1 to 2 p.m. Eastern, with a replay at 4 or from 4 to 5. So keep all that in mind. Make sure you tune in, especially for that Friday show. I know Dave is going to be interviewing Ralph Acampora. I met Ralph at Chart Watchers in October of last year. He's a walking encyclopedia, one of the most interesting technicians I've ever spoken to. I think you'll really enjoy that show. All right, let's get into the Final Bar mailbag. The first question that came in was, how important is sell in May and go away relative to other broad market indicators? Well, I guess everybody might answer this a little differently, but I want to show you on this seasonality chart one reason why I pay no attention to the go away in May. And before I do that, I do want to say that there is some truth to go away in May. If you look historically at the market, which I've done for the last so many years, I've gone back in history for about 75 years to 1950 on the S&P 500. And there is absolute evidence that the stock market, the S&P 500, does not do as well from May to October as it does from November to April. And that's why this whole thing go away in May began. But I've got plenty of reasons why I don't want to go away in May, and I'll show you one of them. So this is a seasonality chart of the QQQ relative to the SPY. Now, I like to use this as a little bit of a risk-on gauge because the NASDAQ 100 is much more represented by high-octane, aggressive growth stocks, more so than the S&P 500. The S&P has growth stocks, aggressive growth stocks as well, but many of those stocks are more heavily weighted in the NASDAQ. So I look at QQQ versus Spider as more of a growth versus value kind of a relationship. And if you look at this and you just look at the relative performance of the QQQ versus the Spider over the last 11 years, why 11 years? Well, that gives us from 2013 to 2023, which is when this bull market began. That's when we took out the highs on the S&P 500 from year 2000 and 2007. So since that time, since we broke out, and since we've been in this secular bull market, the QQQ has outperformed the Spider by a total of 4.7 percentage points. I get that by taking all of this and adding it together. And I just want to point out that May to August, if you add these up, 4.1%. So almost all of the relative strength of growth versus value comes from May to August. You're going to miss that if you go away in May. Second question, NVIDIA has stalled out around $280. Is this still a bullish chart? Well, I can only tell you this. When I look at charts, I like to look at them not only in absolute fashion, but also relative fashion. I like to look at the AD line. This is an indicator of NVIDIA and how it's been accumulated during the trading day. And you can see that line just continues to go up with price action. So I think that's very, very bullish. Here is that 280 resistance that the question was referring to. I think, actually going into option expiration week last week, I thought NVIDIA would pull back. There were a ton of in-the-money calls on NVIDIA as we headed toward options expiration. And that can be a problem even a couple of days into the following week. And so if you look at this, we've been struggling since we got to that 280 level. But make no mistake, folks, we've got semiconductors moving higher. And if you look at NVIDIA relative to the semiconductors, it's been going straight up. Here is your leader in one of the strongest areas of 2023. Would I give up on it now? No way. Now, it has run a lot. Could it pause? Yeah, I definitely think we could see it pause. So for that reason, I would still be bullish, but I would wait and see if I can get it a little bit cheaper. All right, the third question that comes in is a question that asks about Costco. And the question is, do I see a symmetrical triangle, and what should we expect from this symmetrical triangle? Well, the question came in a couple of days ago, and I think we're getting the answer. And this is the answer I would have expected. Here you can see Costco, and maybe you might look at this and say, well, I don't really see a symmetrical triangle, which is one that's squeezing. And I think what would help is if we go out just a little bit further on this chart. So I had a 1-year chart, but let's go out 2 years. Well, actually, let's go out 3 years, because I think even 3 years will even make it look better and easier to see. So here we're going up for the last few years on Costco. And the symmetrical triangle, let me annotate this and show you what I see and where I think the question was coming from. So here, if we connect the highs, we don't need that thick line. Let's go here, and you can see we connect all those highs. And then over here, we connect the lows. Now notice something on a symmetrical triangle. What you should see is a series of lower highs and a series of higher lows. And so what you normally, or what this means, is that the bulls and bears are just fighting this little tug of war, and it just keeps narrowing and narrowing and narrowing, and we're waiting for the breakout. Well, when we see Costco or we see any stock like this with an uptrend, you should be thinking about a symmetrical triangle as a continuation pattern. So we're looking for the break to the upside. That's what I would be looking for. I think we're getting it. The AD line looks great. Costco has been a tremendous relative performer. And so I think this is a good looking chart, and I think it is now executing to the upside. The final chart that I had for you, or final question I had for you for today, someone asked, do I see a negative divergence on the QQQ looking back from February to April? And the answer is, by definition, yes, I do see one. Here you can see easily higher prices, and the PPO is lower. Whether you use the PPO or you use the MACD, either one doesn't really matter. This is a chart that normally what I would expect is a pullback for a period of time. Now, I'll just add one thing, and this is a personal preference for me. When I see the PPO after this initial top, the PPO go back to zero, I treat it as a reset. So when we go back up in price, I'm looking at this as though we're starting over again. So I'm not particularly a fan of looking at this thinking that we have to see a bunch of selling, because I think we've already seen the selling. I want you to think about what it means to get a zero, a center line test on the PPO. The PPO, if you look over here, the default is the PPO is the difference between your 12-period EMA and your 26-period EMA. When it's at zero, there's no difference. You have no short-term momentum at that point. Momentum's gone. It's been erased. So when you start to move back up, all the data in this PPO calculation is different than the data that went into this PPO calculation. Because remember, this is a daily chart. We only go back 26 days. So if you're looking at two tops that are 2 months apart, you have no similar data in this review, right? So it's something that I look at maybe differently than a lot of other technicians. And I'm not saying I'm right. It's just the way that I approach the market, and that something that works for me. So once we get that test, I don't know if the QQQ is going to go higher or lower from here based on the PPO. Now, I may have my own ideas as far as, where I think it's going based on other signals, but the PPO is a neutral signal at the zero line. So where are we going to go? Well, in this case, we turned back up. I'm seeing bullish momentum accelerating off of the zero line. And right now, simply pulling back and testing, excuse me, that rising 20-day EMA, which is down at what, 314.93? And currently we're trading at 315.95. So I'm not really seeing anything out of the ordinary for me. I would not be expecting anything more, anything further based on this negative divergence. Again, just to summarize, I think by definition, anytime you have higher price and a lower PPO, lower MACD, lower RSI, anything momentum related that's lower with higher price, by definition, that is a negative divergence. But the way I play them would be a little bit different. All right, we are now going to switch over to the 3 charts in 3 minutes. I'm going to give you my take on the 3 aggressive sectors. So I want to start off with the XLC. And the reason I'm going to start off with this one, I'm going to actually take this back a little bit. Let's go back 3 years on this one. And I want you to see this move down that began back in September of 2021, straight down. But I want to annotate this and just show you quickly the neckline right here. You see these highs? In a series, in a downtrend, normally you have lower lows, lower highs. When you start to get equal highs, it starts to set a potential bottoming head and shoulder pattern. Here, left shoulder, neckline, head, right side of the neckline, right shoulder, and now we're back up here testing. I think the XLC on a breakout above 60 would be an incredibly bullish development, and that is something that I certainly would be watching closely. The next chart I have is the XLY, consumer discretionary. This one has been a little weaker. It is trying to trend up off of its 20-day moving average, doing a pretty good job so far. Upper end, we've got resistance at about the 156, 157 area. Back to the downside, we've got support right around 135 over here in January, and then maybe 135.50 in March. So I think we're just consolidating. I think we have a short-term uptrend in play. We're consolidated. I'd like to see a breakout maybe above that 150 level, and I think that would start to paint just a little bit more of a bullish picture here for the XLY. The last one I wanted to go over with you is the XLK. This is technology. This is the group that tends to lead the stock market in secular bull markets. And the question is, are we in a secular bull market? I think everyone's trying to come up with that answer. Are we in a secular bear and we're going to roll back over? Or are we in a secular bull and we're just getting started on this move to the upside? And a lot of folks are coming down strongly on both sides of this equation. I can tell you, for me, my signals are pointing to higher prices. I believe we're going to get a big move later this year into next year. I see prices much higher, and this is a chart to watch, because if this goes back up and can break out above the August high, above the early April high, that would start to provide us a much, much, much more bullish look on not only technology, but also the overall market. Keep something in mind. The XLK, the technology area, is 27% of the S&P 500. That, along with the XLY and the XLC, discretionary and communication services, these three groups account for close to 50% of the overall market. So when these three groups are doing well, the stock market can't help but move higher. So these are the three charts that I certainly would be trying to keep an eye on as we move throughout the rest of earnings season and into the spring and summer months. All right. Well, it's hard to believe, but we've come to the end of the show. I've been looking forward to coming in here and taking over just for a very brief period for Dave as he enjoys the CMT Symposium in New York City. It's been a real pleasure being with you here today. Got some great guests coming up the rest of the week, including Bruce Fraser tomorrow. Have a great day, everybody. Happy trading.